For this real quick. Okay, so welcome everyone to this. I don't know if it's training seminar. I don't know what to call it exactly. I just thought it would be fun to sort of deep dive into some of the sort of estate planning topics and things that people are asking me about. Some of the things that I'm curious about and learning about. You know, I do a lot of videos that are shorter. Which makes it a little bit harder to go in depth. And then, you know, plus it's just an opportunity for me to provide just a little bit of additional value to all of you, to also just, you know, see you and interact with you. These are going to be, for all of you that are here, this will be, is being recorded, obviously. So I'm going to have a place that this can be accessed. My plan is to do these every month on the first Friday of the month at noon. So if a topic intrigues you, I would love for you to show up. If it doesn't, then, or you can't make it, then they'll all be recorded and you'll always have access to those. So charitable remainder trust is something that I created a couple of short videos on in the past and have gotten a lot of comments and people wanting to know kind of more about them. They can seem relatively complicated on the outside, and in some ways they are, but I thought I would try to take my stab at breaking these down and sort of discussing them and showing you how they work, so that if a situation ever arises where you want to use one, then you kind of have this tool in your arsenal. Okay. Oh, one last thing, as far as if anybody has questions, I think there are two ways to do that. There's a chat bar in here. Also, I think I'll probably just pause from time to time and just ask if anybody has any questions. Okay. If something has just really got you fired up, just wave your hands and I will stop and talk to you. Okay. So as with most of the ways that I do things, you know, I sort of tend to be much less formal in style. And actually, if you wave your hands, I may not be able to see you because I'm going to share my screen in a minute because I got just a little like PowerPoint slides. So just raise your hand or put something in the chat. I will definitely be able to see those two things. All right, let's get started. I'm going to share my screen real quick. Let's see how we can do this. Let me find the right one. Okay, can you guys see my screen? Yep. All right, perfect.
Yeah, we can.
Excellent, thank you. So as the name implies, everything you wanted everyone to know about charitable remainder trusts, but didn't even know to ask. All right, so do you ever wish there was a vehicle that would allow you to give to charity, avoid capital gains taxes, create an income stream, take a charitable deduction, be smarter, look better, and make people jealous of you? Charitable remainder trust can do some of those things, okay? Not all of them. Like, we're not miracle workers. If you don't think you're pretty enough, you know, that's you're gonna have to just make your own adjustments there. But some of these other things a charitable remainder trust can definitely do. Okay, charitable giving for sure, as the name implies. You can avoid / defer significantly capital gains taxes. We're going to get into all of these in a lot more depth here in the next next 30-45 minutes or so. Create an income stream for you, create an income stream for someone that you like, create an income stream for basically anybody that you want, and get an immediate charitable income tax deduction. All right. Okay. And even in some cases, stretch an IRA. So this is one of the things that I think is most interesting about a charitable remainder trust. Something that I know for me, when the stretch IRA went away, when it was taken away, that caused some pain for a lot of people, and sort of could have deterred some of your long-term planning, for especially when you're gone and you want to pass down your retirement accounts. Okay, so charitable remainder trust can allow you to stretch an IRA. We'll talk about that, how that happens. The other things, being smarter, being, you know, people liking you, being prettier, you're gonna have to do those on your own, unfortunately. Okay. Although, if your money's right, you know, you'll have a smile on your face. People will like you better. That's true. Okay, so get out there and smile. So how do we do this? Charitable remainder trust, right? Also known as the CRT. I was going to refer to this as the CRT throughout, but instead of like asking, people hop in late, I'm going to usually refer to it as a charitable remainder trust, but it's also known as the CRT. There are also two sort of different distribution methods. One is an annuity and one is a unitrust. So you may also, like if you're out there in the real world, see referrals to a CRAT or a CRUT. That is a charitable remainder annuity trust or a charitable remainder unitrust. They all are essentially the same things. The difference is really, for the most part, are you having a specific distribution every year that doesn't change? Or do you have a percentage every year that can change depending on the amount of assets that are in the trust? Okay, so like the annuity is the annuity, I believe, is the percentage split out. So if you have $1 million and you get 7%, you're getting $70K 1 year. If you have 2 million, you're getting $140K the next year. The unitrust is just $170K every year, whether it's $1 million or 2 million or 100,000, you're getting the same payout every year, right? Okay, by the time we're done, you're going to know what these are, how they work, and the different ways to use them to your benefit. All right. That's basically our agenda for the hour. This is not going to last an hour. I don't know how long it's going to last specifically. I wanted to leave some time for questions in case anybody had any, because you might. But I really wanted to sort of just top level overview what these things are, help you identify when you might want to do them, and then also some interesting things that you can use them for that you may not have thought about. Okay, let's dive in. All right, what the heck is a CRT anyway, right? First of all, charitable remainder trust is an irrevocable trust, okay, which means once you create it, it is very hard to uncreate it. There are certain things that you can change with irrevocable trusts. There are certain things that you can change with this specific type of trust, but for the most part, it is not revocable, right? It is not changeable, right? That's important to know because you want to be sure that you are doing what you want to do, okay? CRT is also known as a split interest trust. The, the non-lawyer way to describe this is just mean it has two purposes, right? And in this case, you're going to have the charitable purpose, and then you're going to have the non-charitable purpose. So you'll have the charitable gift, and then you'll have the income distribution to just a regular, normal person. Just like this says, right? Assets in the CRT are used for charitable giving and as an income stream to a non-charity beneficiary. More specifically, income is paid out to a beneficiary for a set number of years, and whatever is left over at the end is given to charity. What that amount is really going to depend. We'll sort of get into that here in just a little bit. And there's more, okay? By the way, but wait, there's more for me. This is always funny. This is a sales thing. You know, if you ever watch like the TV sales pitches, they like Ginsu knives, you know, they go, and then like, but wait, there's more. So I always like to throw those in there.
Now, how much would you pay?
That's right. Exactly. There's always extra, right? Because the trust has a charitable component, any asset that is put into the trust when it is liquidated pays no capital gains tax. Okay, so this is why a charitable remainder trust can be very attractive in certain situations. If you have a business that you want to sell and it has a very, very low or zero basis, you may want to put it into this trust and then sell it. You pay no capital gains tax on the sale. Okay, so if it's or any tax of any kind, no income tax either. And we'll get into that with retirement accounts and things like that. But that is what makes this vehicle attractive in many, many ways. The downside to something like this is you typically are not going to be able to extract all of your value at one time, right? You do have to take distributions over a certain amount of time, but you can avoid the capital gains tax and utilize the total value to invest, which gives you a lot of upside if the situation is right. Okay. Does that make sense, everybody? Hope it does. Okay, good. Okay. And although the charitable distribution itself happens at the end of the time period, which in some cases can be many years later. You can have these distributions go out on the lifetime of a person. You get the immediate, or you get the income tax deduction immediately. Okay. So let's say you have $1 million that you put into this charitable remainder trust. There's a formula that you will plug in some numbers, and it will tell you what the charitable income tax deduction that you get for the year. Okay. Typically, it's going to be some variation on the theme around 10% of what you put in. So if you put $1 million into a charitable remainder trust and liquidate it, you'll have $100K available to you for charitable income tax deduction that you can use in that year, or you can stretch out over 5 years. Okay, that's sort of like accounting stuff, but just know that the income tax deduction that you get is immediate. So not only do you avoid the capital gains taxes on the asset that you're putting into the trust, you're also going to get the added benefit of the charitable deduction in the year that you do all of this. All right. Sounds great, right? It is great. It is great. It's almost as if I made this presentation myself. So I thought this would be a great time to do an example, and we'll sort of carry this throughout the training or the whatever we're doing. But sometimes these things just make more sense when you're talking in examples. Okay. So Fred, he bought a piece of real estate in Seattle 10 years ago for $250,000. Okay. Which is the tax basis. Tax basis, just real quick, high level. This is going to matter when you are calculating capital gains tax. Capital gains tax is basically what you pay on the appreciation over what the tax basis of your asset is. Okay. It's now worth 1 million and he wants to sell it. All right. The problem is he talked to a CPA and it looks like he's going to have to pay at least 20% in capital gains tax on the appreciation, right? So that's 750K or about 150K. I realize that these numbers may not be exactly right, but high level, they're close enough, right? We're going to be paying capital gains tax on this appreciation. That's what 20% of 750 is, 150K. Nobody really wants to do that if they don't have to. Okay. So instead of taking the tax hit, he creates a charitable remainder trust. And by the way, I realize that there are some other things that you could do if you have real estate. Maybe if you have a business with 1031 exchanges, there are other things that you can do. Those things, though, only really serve to defer the capital gains tax over time, right? If you ever liquidate, you are always going to have a capital gains problem for the most part. Instead of taking the tax hit, he creates a charitable remainder trust. He puts the real estate into the trust and then sells it. Okay, so that is typically the way that these operate. You have this asset that's highly appreciated. You are going to put it into the trust and then you are going to liquidate it at that time. This could be real estate. It could be a business, cryptocurrency, stock, basically any highly appreciated asset that you want to work with. This is sort of how it works. Once you liquidate it, I think because it's in the CRT, there's no capital gains tax owed. Okay, because this has a charitable purpose, you are exempted basically from having to pay any capital gains tax. If you put an IRA in there, which we'll talk about, there's a very specific way that you're going to do this with retirement accounts. When they are liquidated, you would not pay any income tax on that. Okay, the very specific way, by the way, to do that is after you die. Okay, so you would fund a charitable remainder trust with your retirement account after you die. If you do it before you die, it doesn't work, right? But when we're talking about stretching an IRA, that's what you would do anyway, right? You would give it to your kids or whoever, and then they would stretch it off of their life after you die. That's the same thing that we're trying to do by way of this charitable remainder trust. Okay. So instead of having only $850 to invest, you have the full 1 million that you can reinvest. Okay. Once you liquidate this money, it does not have to just sit as cash. It can be reinvested in virtually any way that you want. It needs to be done in a, I guess, the first thing I'm thinking of is a non-reckless manner, right? You're not necessarily held to the prudent investor standard, which is a specific legal standard, but you need to make sound investments. But you have the full 1 million instead of the 850. So you're already on the plus side. Okay. He does that. Then he gets to take an immediate charitable deduction on his income taxes of at least 100K. So the 100K is not a dollar for dollar. It's not going to reduce your income tax by 100K, but it will reduce your gross income, and then you're taxed off of that, right? You guys give to charity, you know how this goes. If not, your CPA will be able to tell you. Okay, and then you can stretch this out over 5 years if that's more advantageous for you and your specific situation. Over the course of and you can pick your term. So he picked 20 years. You can pick a specific term no longer than 20 years, or you can do it off of the life or lives of people. Okay. So he picked 20 years. He picked 7% as the number. And there you can pick a number, and we'll get into this more details, but he picked 7% of the value of the trust. As those distributions happen, income tax does have to be paid on those distributions. Okay. So you don't get to defer the tax forever, or you don't get to avoid the tax forever. It is deferred, but typically you will be paying less income tax on these sort of stretched distributions over time than you would be if you paid on one big, huge lump sum distribution in one event. Right? So over the next 20 years, he's going to pay himself $1.4 million. And at the end of the 20 years, the balance will go to the charity of his choice. And in this case, under those numbers, that charitable contribution is probably also going to be pretty high, right? Unless the market just absolutely tanks, that will probably, if you get 7% growth every year on your investments, it'd be $1 million that go to charity. So you kind of get to have your cake and eat it too. You get to cash out of your investment. You get to give to a charitable cause that you care about. You get to sort of give it to the man, for proverbially, and you get to have it all. That makes sense? Questions about any of that? And again, I can't see everyone on my screen, so if you do have questions, I think if there's a hand raise button, or if you type it into the chat, I'll be able to see you. Okay, questions? Questions, anything? Not seeing any. All right. So this vehicle is nice, right? It's like I said, it's not too complicated. There are certain things that need to be done, but high level, it's a way to really take an appreciated asset and have your cake and eat it too. Okay. I thought the easiest thing to do, the best thing to do maybe, now that there's hopefully a sort of a high level understanding of the way that these things work, is to just go through some frequently asked questions. And what I literally did was sort of go out in the world and look at what people were asking, and then hit these up, because these may be things that you were thinking about as well. Okay, the question number one, who can be the trustee? And maybe more important, can you be the trustee of your own charitable remainder trust? Oops, pretty much anyone. You can be the trustee of your charitable remainder trust, and that's what a lot of people will do. That also gives you the authority to run the investments. So if you're someone that likes to keep your hand on things, that you want to be in charge of the investment decisions that are made inside of this trust, you can do that. Okay. There is one important thing to consider. If you think you are going to be smart, and I guess this kind of could be a smart move, and have the charitable organization be a donor advised fund that you have created, you can do that. Okay. That is possible. Just know that if you are the trustee and it is your own donor advised fund, they do recognize that there's a little bit of a conflict of interest there, and they will likely be more scrupulous when they are looking at your books. There will be tax filings that you need to do when you're going through these things, and they tend to look more closely at those only because there's more opportunity for shenanigans in this scenario. Okay, hopefully that makes sense. But being your own trustee is something that you can do. It's something that a lot of people will do, and it makes a lot of sense in most times. Yeah, David, what's up?
So I'm curious about the donor advised fund. are you able to do like a side-by-side comparison of how they're similar, how they're different? Because I had been hearing a lot about donor advised funds lately, but then when I saw this, I thought, oh, that's what you're talking about, but I guess you're not.
A donor advised fund is like its own, it's like a charity that you create, right? You give money to that fund, and then the fund is in charge of distributing that money out in the way that you want. It's sort of a way to give you additional control over how the money is used, as opposed to just giving it specifically to a charitable organization. That's what I know of them. I don't set up donor advised funds. It's something that is definitely outside of my area of expertise. But I know that when you create a donor advised fund, as the name implies, the donor advises the fund, right? So the person that creates the fund is typically in charge of how the resources are allocated. Because of that, it just raises some red flags. Typically, if you did not do a donor advised fund, in this case, let's say you would just do like Red Cross, okay, just making up a charity. You would name Red Cross would be the charity that at the time that the trust was ready for distribution, a check would just get cut straight to the Red Cross for the whatever was left in the trust when the event happened, either the time elapsed or the person died. So the trust that event happened that triggered the distribution to the charity, the charity would just get cut the check at that time. Does that make sense?
Yeah. Whereas if I had a donor advised fund, that would not happen.
It would happen. They're just, the IRS is just, they watch more closely, because what happens in that case is you're cutting a check to your own donor advised fund. It's not technically going immediately to any charity. Does that make sense?
Mm-hmm.
So
Yeah.
they want to make sure that when that money goes to that donor advised fund, that it doesn't just get, I don't know, administratively distributed back out to other people instead of actually going to the charities.
Mm-hmm.
Does that make sense?
Yeah. Thanks.
Yeah. So what I mean is, yeah. So the IRS is just, they watch it a little bit closer, I think, on how those funds are actually used once they get to the donor advised fund, because there's just less certainty than if you just give it directly to a charity. Good. Answer your question? Okay, perfect.
This is John. I have a question.
Yeah.
You talk about a donor advised fund that you create, but I currently have a donor advised fund that I give to. And so I could let the remains of this go to that donor advised fund. And my concern is, if I'm not around for this, right? What if I died in the process, right? Then my donor advised fund, I have, what would they be? Basically, that if I'm not there, then there are contingent people, that basically take it over when I'm gone. And so that it could still be used for charity by my heirs. So that's still true in this event, correct?
Yes, it is. Yeah. You can give it, if you have created a donor advised fund, or if you have family members that are in charge of making the choices, you can still do it this way. I'm just pointing out that if you are the trustee and it is your donor advised fund, the IRS is just they look a little bit more closely at those transactions, just to make sure that everything is working the way that it is supposed to.
Designed, right?
Correct. Yes, you can definitely do it. It is totally okay to do that. I'm just telling anyone that's out there thinking about sort of skirting the rules, to just know that I guess it is technically possible to skirt the rules, but they're just going to look more closely at how those funds are utilized, I think, when they get into those donor advised funds.
Okay.
Does that make sense? But you could, like Bill, I think the Gates Foundation is in a way a donor advised fund, right? I mean, you give to them and then they distribute those assets in ways that they think are sort of the most appropriate. So you could name them and it would just go to them as if it was another charity, right? I think it's only when you are in charge, when it's your fund, that they, like a family fund, that they look a little bit more closely at that. Okay? Anybody else have
Okay.
questions? If you do, then let me know. Put it in the chat, please. Guys, I can only see John and David. So if you're waving your arms at me right now, I cannot see you. Or you can just start talking as well. You guys are so well behaved. Oh, somebody put up something here. What is Sharon? In real estate example. Yeah, you do. You sell okay. So she says, in your real estate example, you say that you eliminate the capital gains tax, but not the income tax. What if you sell the property outright and pay the capital gains tax? Doesn't that take the place of the income tax at the time on the full gain? So when I say capital gains tax and income tax, I'm talking about the same thing. So when the income is distributed out, when those 70K payments are taken out, you're going to pay that capital gains tax in increments over time. So you just can't you don't just completely avoid the capital gains tax because it is being distributed out as income over time. So as the distributions happen, then you will pay some income on that. Sort of like with a retirement account, you know, when those funds are distributed, you're paying some income tax on those retirement accounts. Okay. So the idea is to not have to pay the capital gains tax when you sell the property. You can defer it. So you can take the full value of the property and reinvest it instead of having to take that chunk off the top. Just gives you more to work with. And in a compound interest scenario, that's always better. Okay, hopefully that makes sense. So she says, but capital gains tax is smaller percentage than income tax. So wouldn't it be better to pay it up front? What I'm saying is capital gains tax and income tax in this scenario are the same. Capital gains tax is just one type of income tax that you are paying. So when the income is distributed, you will be paying income tax on that. It will be a capital gains tax rate, but it is still going to go on your income tax return. What I mean is just you will be paying a tax on that as it's distributed out. I wasn't clear on that. Yep. Hopefully that makes sense. I wasn't clear on that for sure. Okay. Anybody else have questions? All right. If you do, just let me know in the chat. Talk, do whatever you need to, and I will happily answer them. Okay. All right. Let's see what's next. Question 2, who can be the income beneficiary? The answer is, again, pretty much anyone that you want. Okay. It is often the creator of the trust can be the income beneficiary. A spouse can be the income beneficiary. Children can be beneficiaries. Pretty much anyone can be. There's no real restriction on who the income beneficiary can be. Okay. Just whoever you want it to be. Question 3, is the income stream capped? Yes. So I alluded to this a little bit. I knew I was going to be answering this question, so I wanted to just I kind of glossed over it at the top. What I mean by is the income stream capped. I talked about 7% payout. The question that often arises is, can I have a 60% income stream off of the money that I put in there? Like, how fast can I get it back? How does that work? Okay. The answer is there is a wide range of options when it comes to the amount of income that you want distributed over time. Okay. Generally, the rule is you have to take at least 5% a year, and you cannot take more than 50% a year. Okay. That's sort of like high level rule number 1. If you break that rule, you're already at a no-go to meet the requirements of a valid charitable remainder trust. Okay. So there is then a second layer. Okay. There's some math that you're going to do. There's a formula that you have. And if you are curious about this, you can literally Google charitable remainder trust calculator, and you can put in the term, you can put in the percentage that you want to take out, and you can put the amount of the asset, and it will calculate whether or not this works. After you do this equation, and after the term of the trust, and if you use it over the lifetime of someone, it goes off of their actuarial table. Okay. So if it's going to be my lifetime, they might say like, oh, I have a life expectancy of 78 years old, something like that. That's how you would calculate the term with regard to the math. When you do the math, the number that's spit out must be at least 10% of what you are initially putting in. Okay. They want to believe at least that according to the math, that 10% of what you're putting in is going to go to charity, right? And then you have one other layer, which is sort of similar to the math that's done at the second layer. That is, the payout is limited to the maximum rate that creates less than a 5% probability that the trust will leave nothing to charity. Okay. And it's said another way, they want a 95% or greater success rate. Part of the way that they do this is the income of the IRS creates a number every month, sort of based on the state of the economy, but I don't know how they calculate it exactly, that sort of takes into account what the likelihood of growth of the asset is over time. Okay. So depending on the month that you create this, that you create your trust, you can have very different outcomes on what this payout number can be. Not very different, but different enough. So what they, yes, John.
Does it also depend upon what you're investing in? It seems to me that, you know, if it's trying to guess 5% probability, if you're, some things are have more risk involved than others, and so that would change this calculation as well.
It does not. Only they are just going, because I believe they're going to be relatively conservative with this number anyway, about what the growth will be. So as long as it works with their formula, they're okay
and
with the outcome.
So in your example, where, you know, it was, you were giving $1 million and you were getting $150,000 credit, if you will, you know, a tax deduction, are they basically saying that they want a 95% chance that it's going to leave $150,000 to charity, or is it just, you know, a 95% chance that it will give something to charity?
It's not. So it's the number that they are aiming for is 10%. Okay. So they want whatever the value is 10%. So if you put $1 million
so
in,
even though you're getting 15 in this particular case, you know, that's some other calculation, you know. So what they're trying for is 10%, and as long as they're trying to get 10%, is it a 95% chance of getting 10% or a 95% chance of getting something more than zero?
95% chance of getting 10%.
Got it.
Yeah. And they don't care how you're gonna, because what'll happen is, let's say we're in the middle of a depression, right? The IRS like form factor that you're going to use is going to be a couple of points lower than it might be than if the economy was booming. So the number that's going to spit out at the end is going to require you to take a lower percentage every year on that income stream to help ensure that the charity gets paid out at the end.
And it's based on what it is at the moment you create the CRT, correct?
So the way it works is, when you create your charitable trust, you can use the month that you're in right now, or you can look back 2 months. Okay. So you have 3 different potential numbers to choose from when you're doing this.
Okay.
So if the numbers are bad, it may make sense to wait, you know, a month or 2 or a quarter or something, and just see if things change at all. It can make a difference in what percentage you can take. If that is your motivation, is to sort of maximize that distribution.
Mm-hmm.
That makes sense?
Yep.
Okay, perfect. So when you do this formula, yes, sir.
And the 10% in this particular case for your $1 million that you donated, is that they're hoping for $100,000, correct?
Correct.
It's not the 850 or so. It's 100. Okay, 10% of what you totally give. Got it.
Yeah, the 850. They don't care. They actually don't care. They don't factor in the capital gains tax that you're saving. That really doesn't go into the equation that we're talking about here. What they're most concerned is 10% likely to go to charity, right?
Got it.
Yeah, the vehicle was you think about, to take a really, really high step back real quick. If you go look at the IRS code, it's like thousands of pages, right? Maybe 1,000 pages, let's say. I think if you actually go and look at it, 35 pages or so are the only thing that are actually dedicated to the taxes that are paid. The other 965 pages are dedicated to exemptions and credits and things like that. The main purpose of the tax code is to encourage you to move your money in ways that they would like you to move it. Investing, that's why you have a lower capital or a lot lower tax rate if you invest. That's why you get tax, deductions if you go to give to charity. They are trying to get you to do these things. So the main goal of this vehicle is to encourage you to give to charity, right? So they're willing to sort of give you some breaks to entice you to give to charity. So what they really care about, in my opinion at least, is that charitable aspect. That's why they do this formula to help ensure that that actually will happen. Okay. All right.
Mhm.
Okay. Okay. So in the real world, when you do this math, it's going to be very hard for you to get over a 15% per year income distribution. Okay. You're just not going to be able to meet those three criteria and get over 15%. It just, the math gets too wonky and it becomes too unlikely that the charitable contribution is actually going to be made. Okay. Whoops. Okay. We talked about this a little bit. Question number 4, how long can the payout term be? There are two choices that you can really make here when it comes to payout terms. First is 1 or more lifetimes. And this is as determined by actuarial tables. And typically, if you're talking about more than one lifetime, what you'll often do is like a married couple, spouses. So they will be the sort of the joint income distribution recipients. And then when the last of the two of them dies, then the gift will be made to charity. Okay, so that's what we're talking about here. When it's more than one lifetime is typically how that's done. Okay. If the beneficiary outlives the actuarial numbers, the trust doesn't dissolve. It actually continues until they die. Okay, so the IRS is sort of forced to make a bunch of assumptions at the very beginning. Those assumptions carry out forever. So if I would live to be 95 years old, this charitable remainder trust would continue past my 87th birthday, or my 88th birthday, even though I was supposed to die by that time. Okay. The numbers at the beginning are just done to help ensure up to 95% that charitable gift is made at the end. If I live to be 100, I might be an outlier and I might fall into that percentage where the charity does not get everything that they hope they will get. Okay, does that make sense? You're not stuck to the actuarial numbers. The real world plays out. On the flip side, if you die early, the balance will go to charity when you die. Okay, regardless of what's been paid out. So if you die quickly, I mean, that's not that, I guess nobody wants to die. So not to say that this is a good thing, but the higher balance is going to go to charity. All right. So that's just the way that these work. And you're not, just the way that they work. And we'll talk about some way to sort of hedge against these outcomes that you may not want in a little bit. Does this make sense though, these two things? Okay.
Yep.
Good. All right, let me see here.
I have a question.
Yes, sir.
So when we talk of charity, we're always talking about, registered charities, 501c3s, those.
Yes.
I can't say like my sister-in-law is a charity.
Correct. Your kids, while they might be charity cases for you, they do not qualify under the IRS rules for the charitable trust to be given. Yeah, they have to be recognized charitable organizations, as defined by the IRS. Yep.
And do we have to, can the CRT be only designated for, say, one charity, or the trustee can determine, which charities, and there can be multiple charities?
So the answer is sort of yes to all of those things. It's actually a question that we're going to get to later, but you can designate multiple charities to be payouts. And this is one reason why people often want to remain as the trustee of the trust. You can also change the charities essentially anytime that you want before you die. So if I don't know, if Red Cross does something you don't like, and you want to change it to, I don't know, Blue Cross, I know that's not an actual charity. If you want to change to someone else, then you have the ability to do that. That's one of the few things that you can change with this irrevocable trust, that you retain the ability to change. Okay, makes sense? All right. Oh, so the second option that you can take when it comes to distribution schedule is a specific term of years not to exceed 20 years. Okay. And again, you just plug these numbers into the calculator. It will spit out what your maximum allowable payout is over time, and then you will do that. Okay. And how you choose this is kind of up to you. You know, if you have a shorter term, you are likely going to have, I think, well, it depends on what the numbers are, on what your payout will be. But this is also an option if you want it. A longer term over time typically means a smaller charitable deduction, right? Only because the balance just gets paid out more and more and more over time. There's just more opportunity for volatility. Okay, side note, the term of the trust itself is utilized more for determining the present value of the charitable deduction than anything else, right? That, like we talked about, all they care about is coming up with an idea to have some certainty as to the amount of the charitable deduction when this thing is over. That is mostly what they care about with this math. Okay, question number 5. Does the money that is expected to go to charity have to be set aside or retained? So let's take our example. You have 100K that's expected to go to charity. Do you have to somehow retain that? And does it have to exist? Does it have to be there? The answer is no. Okay. Formally, nope is the answer. Okay. The IRS doesn't actually care about reality. They're willing to gamble that we're going to die early or that their math is good. Okay. So if the market tanks and the amount in the trust goes down significantly, and you end up not making much or any at all of a charitable contribution at the end, the IRS doesn't care. They do not monitor those type of things. Okay. They will monitor what happens within the trust. You'll have records to file with them. But if in the real world, you don't end up giving 100K to charity at the end of the trust, they don't care. You don't pay it. There's no requirement to actually make that payment. They're just trying to make it as certain as possible that it happens. Okay, that makes sense? All right. If you die early, a large amount goes to charity. We're not talking about that. Okay. If you live longer, though, you're going to exhaust more and more and more of those resources, potentially down to zero. Because if you have, for example, if you for some reason get a 15% payout and you do that over let's say you are 70 when you do this, and the math works where you can take a 15% payout over time and you end up living instead of to 85 or 87 to 95, there's a good chance you're going to exhaust a lot of those resources in that trust, because you will, it's not as likely to be able to replenish at a 15% rate what you are taking out. So you will be diminishing the balance of those assets over time. Okay, hopefully that makes sense. The longer you live, the more trust assets are depleted, the less there is for charity when you're gone. Question number 6. Are there any sneaky ways to use this to accumulate additional assets? Yes, there are. And this, so David, can we change the percentage of payout income to ourselves? It's set at the beginning. So whatever you pick, that's what happens. That is the irrevocable nature of this trust. And I think partly because that goes to the math. Okay. So if you end up not needing that money, you can always give as it comes to you. You can distribute it in different ways and you can do different things with it, but that amount will be coming to you every year until you die or until the term is up. Okay. All right. So are there sneaky ways to use this to accumulate additional assets or replenish what you've parted with or hedge against your early death? Sort of different ways to say this. Yes, there are. Okay. Yeah, I said sneaky. They're not sneaky, right? We're just playing the game with the rules we've been given. So as many famous rappers have said, I believe, Don't hate the player, hate the game, right? We're just playing the game. So to take our example above, right? Quick recap, $1 million asset, you liquidate it. It's going to pay you $70K a year over 20 years. You are worried though, that maybe you will meet your untimely demise in year 3. And you will have, although you're happy that these assets are going to charity, you would like to be able to preserve some of these things for your family. Some of this money that was to be paid out, you wanted to be able to give it back to your family over time or whatever. Right? Here we go. Here's the trick. Step 1 is to create an irrevocable life insurance trust. Irrevocable life insurance trust at its highest level is another type of irrevocable trust that essentially houses a life insurance policy. Okay. You, as a sort of a person, gift money into that trust, usually on an annual basis to cover the premiums of the life insurance policy in that trust. And often the policy will be on you if you can qualify to get one. So you fund said trust with a life insurance policy, take out and make it $1 million is the death benefit. Okay. In parentheses, I said this type of policy would depend on your cash flow requirements. If you didn't need the money right now, you might consider a whole life policy where you're gonna fund it with cash. And there's other fun, interesting things that you can do with that. If not, a term might be better. Obviously the premiums will be lower, but you'll pay more. You don't have the cash value built up into it as you invest in it. So that's just a little side note. I might talk about more about this in like next training or coming up soon. Dive into this a little bit. This idea of like generational wealth and infinite banking, things like that. Okay. Step 3, then, once you have created this life insurance trust, you've got this policy that's in there, is you use the income stream from the charitable remainder trust to fund your life insurance policy inside of that irrevocable trust. The great thing about it being in an irrevocable trust is that when you die and that life insurance policy pays out, it's not part of your estate, so you don't pay any estate tax on that. You're not paying any income. There's no taxes associated with that life insurance trust. Okay, so you kind of get to re-up what you've sent out. That makes sense to everybody? This is what the, if you Rockefellers, big those families that that have generational wealth, they utilize a tremendous amount of life insurance to replenish the funds every time a generation dies. So this is one of the ways that you could do this. One of the ways that they would do it as well.
It doesn't have to be $1 million, right? That was just an example. You can put any amount.
Yeah. The only reason I said $1 million because in the example above, it was a $1 million asset that was put into the trust. So
Okay.
you just wanted to make sure that you are retaining that asset that you put in to be able to give to your family if you died. Yeah, it could be, the insurance policy though could be whatever amount you wanted. If you're putting $70K a year in, you would probably be going higher than that anyway. That would be a financial advisor question, can run those numbers and tell you what the different options are with that. But it depends on if you want to cash heavy or not.
Okay.
Okay, cool. Anybody else have questions? David, what's up?
Do we have to, can we contribute over the years to this CRT, or we're just starting with one lump sum and then it stays?
So that is a good question. The answer is it depends on what type of charitable remainder trust you choose. And I can't remember which one is which. For example, the annuity trust, I believe, only allows for a one-time donation. All that means is if you want to do it again, you just would create a separate charitable trust, right? So you're not limited to one of any of these. You could have 10 charitable remainder trusts. You could have 10 life insurance trusts. With the unit trust, it does allow the option of adding in more assets over time. Okay, does that make sense?
Yeah, thank you.
Yep. It's going to kind of depend on what your long-term sort of goals are, right? How you see that going, on what you might want to do. I think for most people, it's going to be an event where they have a specific asset that they want to get into at that time. Only because the best assets to use these are going to be highly appreciated assets that you want to liquidate, soon. If you have a lot of those, you could do them all at once. Does that make sense? If you have a lot and you have a plan to do them over time, then that may change what you pick anyway. When you contribute more assets, it will not necessarily change. I don't believe it will change at all the numbers. So the distribution amount will not change. The different trusts just allow you to add additional assets if you want. You will get to take the charitable deduction when you put in the new asset, but it does not change the payout.
Mhm. Okay, great, thank you.
Yep. Okay. Oh yeah. So I could talk about the insurance policy is basically there to help fund the needs of your family if you would die early. And if you live to your life expectancy or beyond, then you will not only have the income from the charitable remainder trust, but you will also have the asset of that life insurance policy that will pay out after you're gone as well. So you just are creating another asset for the family. Okay, this is what we're talking about. Question number 7, can I name more than one charity? Yes, you can name as many charities as you want. And you can also retain the ability to change those charities over time. Oh, here, what if my favorite charity changes? Same, okay? The trust can be designed to allow you to change charities at any time. I think typically you would bake this in no matter what, just because you never know what's gonna happen in the future. Things change. Charities, particularly, well, I'm gonna get only mildly political on you here for a moment. But I think if you look over time, particularly in the last 20 years, certain nonprofit or charitable agencies have really changed the way that they operate and changed their philosophy in a sense that may make you want to not contribute to them anymore, depending on what your values and beliefs are. Okay, so I would bake that in just because things do change over time. All right?
Also, another thing for the, if a charity did terminate at time of death, you can add something in the trust, right, that says like, or a like cause, and then it would be up to the trustee to pick something similar that you might have been interested in.
It depends. With these, I think you would need to specifically name the charity before.
Okay.
Yeah.
Okay.
I know we can bake that sort of language into revocable trusts. I would have to look to make sure.
Okay.
Yeah. The answer with some of that's a good question. The answer with some of these questions is going to be, we just need to read the specific regulations and laws to see what we're allowed to do.
Okay.
Yep. It's a good question though. All right. And then question number 9, this is the last question. I think we're almost out of time. So I'm going to go through this pretty fast. And if you have questions, I'll hit you with them. Okay. Oh, is there anything else you can do? Oh yeah. This is the inherited IRA, stretching the IRA part of the talk. Okay. So 2 or 3 years ago now, I can't remember exactly when Trump's new tax bill was enacted, certain good things happened, right? The estate tax exemption amount was raised to $11.7 million per person, but they eliminated the ability to stretch your IRA when it was inherited by basically anyone other than a spouse. There are some other exceptions, but that's generally where most people are going to come into play. What I mean by stretch is, if let's say you died and you had $1 million IRA and you gave that to one of your kids, to a child, the child at that time with the old law had 3 options. Option 1, they could take an immediate distribution. Option 2, they could take a distribution over 5 years. Option 3, they could stretch the distribution schedule over the time of their actuarial life. So for me, I'm 41. If I would have received an $1 million life insurance policy and I was to live to 87, in year 1, I would take a 1/46th draw, right? In year 2, I would take a 2/46th. similar to the way that you take your retirement distributions. The great thing about that was if I inherited that, by the time I started taking real significant distributions, that thing had the opportunity to grow significantly. The downside for the government was they didn't get their income tax payouts for a very, very, very long time. So they wanted to eliminate that possibility. So they changed the rule to now there's just really one rule for everyone. Whenever you inherit an IRA, you have 10 years to distribute, to liquidate the whole thing. And as you liquidate it over those 10 years, you're going to pay income tax as those things are paid out. Okay. It also makes it tricky because if you wanted to sort of set up a retirement plan for your kids that they sort of had less say in, you could do that with a stretched IRA or inside of a trust as well. You can do an IRA trust. You can't do that anymore. This will allow for that to happen. Okay. Okay. We talked about that. Yeah. And because the distributions happen over 10 years, typically you're going to find yourself in a higher income tax bracket with each of those distributions whenever you take them instead of stretching them. Okay. With a charitable remainder trust, you can fashion your own stretch IRA. Here's how. Step one, you create the CRT, which we've been talking about. Step two, the beneficiary of that CRT becomes the child or the children that you want to make payouts based on their lifetime. Okay. Number three is you're not actually funding this charitable remainder trust until you die. And then when you die, the charitable remainder trust is going to be funded with your retirement account. Okay. When you die, the retirement account pours into the CRT. It's liquidated at that time, just like any other asset. When it's liquidated, there are no taxes owed. Okay. Then you can make annual 5% distributions over the lifetime of your child. Okay. So you have essentially created a scenario where you get to stretch this IRA, where you are only paying income tax on the distributions as they occur, right? And you can do it over a significant amount of time, allow for significant growth potentially of the assets. You can beat 5% a year, basically. And, you know, you have the added benefit of giving to a charity when it's all said and done. Okay. So this is like one of the very few sneaky ways to stretch an IRA if you want. Okay. Does that make sense to everybody?
Yep.
Okay. No, I went super fast. We're out of time. It's a backdoor stretch. Fun, right? Okay. And last thing, question 10, I didn't want to talk about this real quick. What's the cost to put one of these things together? Okay. I do flat fees only. You guys know this, right? These things can be a little complicated. Values off the charts, $3,500 basically what I charge for this kind of stuff. Okay. So I just want to let you know, everybody wants to know what the price is, but you know, the savings and the value is really, really high. The complexity is slightly high. So the price is a little high. And you get to work with us and we're fun, right? We make you smile. Okay. So, so you guys are watching this now, but if anybody's watching this in the future, you guys can always just set up a time to talk, just like we always do. And, you know, we can talk more about your specific situation, see if it's a good idea, see if it will do what you want. And if it does, that's great. You know, we'd be happy to help you. All right. Any questions? Any quick questions? I'm going to unshare real quick so I can see all of you. I know I went fast because I thought I was going to not have time, or I thought I was going to have plenty of time, and then I did not. So if any of you have questions, let me know. Otherwise, we'll kind of wrap up. It's 1:03. I want to respect everyone's time. You know, this is being recorded, so you'll have the opportunity to kind of go back and refresh if you need to. But I'm happy to answer questions.
Is this going to be posted on your website?
So yeah, so what I'm going to do is for clients, it's going to be available for free. If you're not a client, you're going to have to pay for it. Okay. So basically it will be on the website. You'll have access to it. And there will basically be like a client code that you put in that will get you into it.
How do we get that client code, or do I
I'll
have it
send it to
already?
you. I haven't created it yet, to be honest.
Okay.
It does not exist. Does not exist.
Okay.
What happens, the way I do these things is, you know, like 3 weeks ago, I said to myself, you know what? I should do a monthly training for my clients. So I sent the email out and then I will figure it out after I commit. So that's what I'm doing right now. So I'll once this recording is done, I'll find a place to put it. I'll find a way to get everybody access to it, and then I'll let you know what that code is for sure.
Great. Thank you.
Okay. Yep. You're welcome. Okay.
Right.
I don't see any other questions. I really appreciate everybody showing up. If you like this, that's great. If you have any feedback, please email me and let me know. The goal is to be helpful, to sort of get you some things to think about. And so hopefully that happened. Okay. Have a great, happy New Year, everybody. Have a great everything.
All right.
And hope to see you
Yeah.
again next
Thank
month.
you.
You're welcome. Have a great day, everybody.
Bye.
Bye-bye.
Bye.